Have you ever tried selling something only to realize it's easier to sell your soul than find a buyer? Yeah, that's market liquidity in a nutshell. Let's break it down before you start selling that old phone for a fraction of the price on eBay. Let's get real. Market liquidity is just how fast you can sell an asset, whether it's stocks, real estate, or your collection of 90s Beanie Babies, without messing with the price. High liquidity. It's like selling hotcakes on a street corner. Buyers everywhere and deals flying. But then there's low liquidity. Imagine trying to sell a rare Star Wars action figure to only 5 nerds in the world who even care. Yeah, good luck getting your asking price on that one. Let's walk through the stock market, shall we? Big companies like Apple or Amazon have high liquidity, meaning you can sell that stock faster than a Black Friday sale. But that painting your rich uncle gave you? That's a prime example of low liquidity. You'll wait months, maybe years, for the right buyer. Meanwhile, you're stuck thinking, why did I even think this was a good investment? So why should you care? Let me break it down. 1. Ease of buying and selling. Need quick cash? Liquid assets like stocks are your best friend. Think of it like selling a popular gadget. Fast, easy, done. 2. Price stability. Liquid markets, stable prices. The more buyers and sellers, the smoother things go. 3. Risk management. Got everything tied up in illiquid assets? Yikes. Good luck selling that third vacation home in a pinch. Having more liquid assets gives you options when life throws a curveball. Market liquidity. It's not just about making sure you're hydrated. It's about making sure you can actually sell the stuff you own. Now, go impress your friends with your new finance knowledge. Give us a like and hit that subscribe button while you're at it for more great content.